All right, so assignment 8 review. First question was on 7.01. Oops, wish my chair is still squeaking. I've got to order it or get rid of it. Now then, the mining operation. We've got annual deposits of $400,000 into a reclamation fund for 25 years, and this is actually a very standard thing that happens anytime you get a federal lease on anything. They do an estimate about what it's going to be like to put the land back the way it was, and they'll have a requirement as part of a federal lease to do this. So the firm must have $17 million when the mine is closed after 25 years. How they came up with that is probably negotiated between them and the federal government or whoever owns it. So I'll pull up my Excel file. Oops, that's the wrong file. Now then, I'll put this up here. So I did it basically 3 ways, because there's multiple ways you can do it. Here's the annual deposits, negative 400,000. I'll zoom in on this section for now. So, and out the door every year for 25 years is $400,000. Then you want to have 17 million in the bank at the end of that 25 years. So one of the simplest ways to do it, and I did it twice this way, is a rate function, where we basically say, where's my formula? Number of periods is 25. The payment you make is 400,000 for 25 years. And the future value is going to be 17 million. And that churns out the 4.15. So that's one way of doing it. Book likes to do tables, so another way of doing it is like this, which is an iterative process, where they say, okay, you basically do the math, and you know that your annuity, and you have that given annuity, future value given an annuity. So you go to that table, and basically you know by doing your multiplication of saying, okay, I'm going to take number of years. I got my 400,000. I got my A part. You basically figure out what the value essentially was. The F/A should be. They say, okay, by taking D6, which is your 400,000, divided by D4, which is your N. So something's going to have to work out to get you a rate around that. And basically you look at the tables until you find something about that that will work, that will make your calculation come true for that 17 million. And basically they happen to have on these, you go through basically table by table, percentage rate by percentage rate, trying to find something that will get you close to that factor. A horrible way to do it, but you had to do it in the old days before modern calculators, and just do a summation series on it. But you basically go and look at different interest rates and say which one, given the factors listed on there, on the F/A, future value, given the annuity, given that you have the annuity, what's the future value? Future value has to be 17 million. $400,000 is annuity. And you basically do through trial and error, go by page until you find an interest rate page that will give you that $17 million factor. And then it tells you what the interest rate should be. Horrible way to do it. So at this point, you know it's going to be in this range somewhere. Now then, not my favorite way of doing it. This way over here, I just put the usual way in the template that the book likes to use with their I, the N, 400,000. This rate calculation is the same as this calculation over on the left. And that gives you that 4.15. Another way to do it is internal rate of return. I just put all the payments here and the final value here to get your net cash flow here. The final year is 17 million minus 400,000 because you still have to put $400,000 in at year 25. And you do an internal rate of return calculation on all the cash flows. And that gives you the same rate as you would up here. Again, this using putting everything in a table using IRR isn't bad, as long as you're not leading with using like 200 payment periods in a big spreadsheet, but it gets you the same place. The internal rate of return on all this is basically to break even at this, you need 4.15. If you get more than 4.15% from the bank, cool, you're gonna have more than 17 million and you pocket the rest. Because remember, this is the break even rate when all these outflows match this inflow at the end. So getting the rate, either by putting in the payments, the future value at 25 periods gives you that, and just putting it in a big table and giving the IRR gives it that. Any questions on this one? Most people didn't have problems with this one. So say that, as soon as I say that, someone's gonna say, oh, I'm not gonna ask questions. Everyone else got it right but me. But no, this is fairly straightforward. Any questions on this one? At least it was intended to be straightforward. Hearing none, let's jump to the one that everyone likes. So zoom into this stuff so you can see. Okay, so 716 is they're installing a new automated production system to save Zia Corporation gajillions of dollars. So it tells you cost, initial cost, annual savings. Probably should put that negative up there, but since that feeds over there, does that feed over there? Yep, I can't put it negative now. But 52,000 savings. It costs you 7,500 to maintain it. It's a 10-year life. At the end of 10 years, you can sell it for $10,000 or $30,000. Now then, here's the tricky part is, and this is where some people got messed up. They messed up. They tried to incorporate this 716. If the company wants to earn 12% on all investments, should the system be purchased? Some people tried to find some way to incorporate this 12%. The way it's saying, it says it wants this. You're trying to figure out whether you can get it. So, did it two different ways. One is, did it quickly with the rate formula again. 10 years time period, because they tell us 10 years is system life. The net savings every year is 44,500, which is that 52,000 it costs you, or you get in savings, minus the 7,500 it costs you to operate it. This gives you 44,000 every year for 10 years. Present value is initial cash flow that they tell you. The future value is what you can sell it for at the end of 10 years. That's your salvage value. And that's reflected down here. When I break this out, this is the calculation column. We have the system is $300,000 to buy. You can sell it for 30 in year 10. Savings, cost, and these all net out to this. And this is where we say the savings need to be incorporated in year 10 because you're still getting this net amount, but you're also getting additional $30,000 at the end of year 10 because you're selling it. So that gives you an internal rate of return of 8.9 or 8.87 by internal rate of return, or we could have just said what rate using the rate function. Now then, the other thing I did on here just for clicks and giggles is to get used to net present value. The net present value is negative. Why would it be negative? Anyone guess why it's negative? Think in terms of what IRR does. We're a bountiful conversationalist tonight. Okay. In order to calculate net present value, you use the interest rate they gave you, which is 12%. That's the required amount. Well, remember, internal rate of return is when net present value is break even. This is less than the discount rate. The rate of return, the internal rate of return is 8.9. The interest rate to calculate net present value is 12. Internal rate of return is less than the interest rate you use to calculate this. So this is going to be negative because the interest rate they require is bigger than the interest rate that is generated from this project, which is the internal rate of return. So you're discounting it with this 12% faster than you can make money, the actual value of the project is less than 0. So for 2 reasons in this case, you don't buy it. One is because you require a return of 12%, you're generating 8.9%, and also the net present value is negative. If the internal rate of return is less than the required rate of return, the net present value will be less than 0. Just because you use this 12% to generate net present value. It uses this 12% interest rate in its calculation. Whoop. Cancel. Whoop. Oops. Oh, it doesn't like it because I have the plus. Now then, one thing I'm going to bring up, we got net present value again, because on last week's homework, a couple of people were still messing up on ranges. When you're going to do net present value, that function discounts it back to year 0. So when you're going to use net present value function, you only use this range, not this, because by using the net present value function on this range with this 12% interest rate, it's saying what are these cash values worth at year 0. That's why you just always have to add back the year 0 stuff, because the function NPV calculates all these values at their year 0 equivalent. Braden, you lost me on it because it cost you 300,000 question. I'm not sure what you're asking. Help me out. Oh, Braden, are you still with us? Wait, you're still with us? Does anyone know what Braden says when he read, because it cost you 300,000? I'm not sure what he's referring to.
It's when you were asking why the NPV was going to be negative.
Oh, well, I mean, technically, it's not just because this is 300,000. It's because the present value of all these cash flows are less than 300,000. So net present, I mean, you can actually tell it's 38,906 is net present value, negative. So that means it's basically the present value of all these. If you just do the net present value of, let me ask that, we'll do them separately just so we can see. The rate is 12% and the values are here. Oops, didn't switch my column. Come on, rate is that, and the values are that. So that's 261,000. Now that's the present value of all these cash flows at year 0. Well, in order to get the net present value of everything, you got to add the other year 0, which is 300,000. Well, it's negative 300,000 plus positive 261 gets you your 38,906. Any more questions on that? Nope, Braden joins us again soon. All right.
Wait, I have a question.
Go for it.
So the only thing I did wrong was I only did the salvage value for year 10. I didn't do any other cash flow. But I got the same answer that you shouldn't buy the system. So would I still get points for that?
Essentially, the calculation in doing that, you essentially would be wrong. You could be right for the wrong reasons. There's a famous story about how Neptune was discovered. I can't remember the guy's name, but he did some inherent calculations using what he knew in gravity over 100 years ago, and decided, and he looked at this area of the galaxy where he thought there should be a planet, and he looked there and he discovered what we now call Neptune. About 50 years later, some grad students for a project redid his calculations and found out that his calculations were completely wrong. And if he hadn't made some math errors, he would have been looking in a different part of the galaxy because his measurements were inaccurate. Now he still found Neptune, but he made mistakes doing it. So his math is wrong. So if you're going to go to your boss and say, hey, I recommended this project, but I did all my justification for it is wrong. Doesn't work that way because you can't guarantee you're always going to be right. So, but that's the main thing. And that's what I find a lot on problems. If someone gets one of these types of problems wrong, it's not uncommon for someone to like, salvage value is probably the number one thing people forget to do anything with. Or they'll forget savings. Some people would put savings but didn't put the operating costs. That's why I say it's always good to take a deep breath and just say, okay, what do I need to account for? Because I know when you're in a rush for this and trying to get it done by midnight, you start throwing things on a spreadsheet or on your pad, and that's when it gets you off. But you'll be off if you don't include
But
salvage
I
value.
intentionally left it out because of the wording. It said at year 10, so I figured once we reach year 10, we're gonna salvage.
These savings here, 52 are at year 10.
But the wording was salvage at year 10, not at the end of year 10 or after year 10.
As the book says, always assume things are at the year. It said this multiple times. You always, just like interest rates, always assume unless it's told otherwise, the cash flows are done essentially at year end. Goes back to our annuity versus annuity due conversations. If this was a time period other than at the end of year 10, they'd have to tell you, and then you'd hope a different calculation scenario would come into play. But no, it's at year 10, this is year 10. If you put it at a year 11, well, that's a different year. If you put it at year 9, that's a different year. It's at year 10. Any more questions before I move on to 17? Whoops, just one. Decimal places generally aren't a problem as long as I can see what they are. That's why I like things in Excel. So if someone put 9.0 or 9 versus 8.9, I click on it and see if you got the right answer. Like a lot of people had on problem 1 had 4. I want to make sure they had 4.15. So on Excel, I can just expand it out. Problem 17. This was fairly compute the rate of return represented by the cash flows. Most people did not have an issue with this. And again, there's 2 different ways you can do it really. Well, 3 different ways. You can do your factors where you can discount this every year, this back 4 years to this, and this back 4 years to that, and this back or 3 years, and then this 2 years back. They like, again, the author loves gradients. So everything here increased by $500 a year. So if you wanted to use the gradient functions for the manually, you could do that. I prefer to do internal rate of return because all you have to do is you only got 4 years, stick this in, and that gives you internal rate of return. But if you discounted it back and tried to offset it somehow, and then use a rate function, this is the far easiest way. I don't think anyone did anything but internal rate of return. You could use a rate function in a complicated way with a gradient, but you'd have to do individual backflows. I think I'm trying to think of anyone who got it right that didn't use internal rate of return on this.
So I forgot to increase the decimal on this problem and on the first problem. Do I get marked down for that?
As I just finished saying, I always check. That's why I like to have the Excel so I can click on it.
I had the formula, and if you increase the decimal, it gets the correct answer, but I forgot when I submitted it.
As I just said earlier, that's why I like it in Excel so I can see what's decimal points. Some people put 13, some people put 12.66, some put others. That's why I like so I can see what your calculations are. All right, the big one, which is the one that's still going to be figuring out how to grade properly because people did more than was expected, but not necessarily wrong. 729 was the one, let me get over to the page, where it's a bond one. Now we did one exactly like this in an earlier chapter, and there's multiple ways to do it. So essentially you're given a face value or coupon value or face value of $1,000. Coupon rate is 4%. annual payments. So you're getting 4% of $100,000 every year. Let's zoom into this section. So it's a little bigger for most people. Okay, now then, so to figure out essentially, and there's a two-step process for some on this. If the bond will be paid off at the end of 12 years, what rate of return will the man receive? So he bought it at 875. Again, present value, money out the door negative, 875. At the end of his time period, 12 years, he gets $1,000 back. Now then, most common thing people mess up on, it's the same thing we did when we talked about compounding on bank loans and that. It's a 12-year bond, semi-annual payments. That means semi-annual, twice a year. So you're actually getting 24 total payments over that 12 years. So you're getting 4% on $1,000 annually, which means $20 every 6 months. So your payment is $20 over 24 periods. You paid $875 for it, and at the end of that time, you get $1,000 back, and that gives you your 2.72 using the rate function. Now, then, before I get down to the 5.5% part, I'll go the other way you could do it, and it gets you the same place. Is if you just did a cash flow diagram. And I did, price, interest, face value, and the net over 24 years. At year 0, you pay $875. You get $20 every period. So that's your semi-annual interest payments. It's a 12-year period, but 24 payment periods. And at the end of that, year 24, you get your $1,000 back because the bond matures. So I netted all those inflows and outflows and just did an internal return calculation on that whole thing. And that gives me my 2.72, same 2.72 as I got up here. So gets you the same place. Again, something smaller like the little block like we use to set up things in the book. That's better if you had this, if this was a 50-year bond, paid semi-annually, and you could do this, a table like this, but then you got 100 lines to worry about. But I put this here to say this is essentially what we're saying to do. It's still an internal rate of return we're looking at for this. Now then, if you'd gone just this far, I would have said, cool. But some people took it to heart and said, if the bond we paid it in a year, what is the rate of return that the man is going to receive? This is the rate of return he's getting, because this is the whole rate of return on it. Somebody went ahead and actually did equivalent annual return on it. And this is where, okay, it didn't specifically ask for equivalent annual return, but some people did it. And what I'm wrestling is some people got the initial part incorrectly, but did the calculations in equivalent annual return okay. Or they got this part right and this part wrong. So I've done my first round on everyone's grading. I'm going through again tomorrow. So any comments you have on your homework so far, that's my first round. And so when I go around, sometimes if I make a comment that I change my mind on, I always try to go and delete it. But if you find something that's nonsensical, like it looks like I marked something off that I didn't mark it off, it might be because I forgot to delete or missed deleting my comments sometimes. So equivalent annual return, and this is where people go into, and this is how they talked about it in this chapter versus previous chapters. And some people try to follow the 7.5 example. And this is where some people got a little held up on how they did the calculations. And on 7.4, they do different solutions. They do a table solution and a spreadsheet solution. I did the spreadsheet solution here. And in the table version, as they call it in the book, they do an iterative process where they try and basically hit above or below it using different rate calculations, then say, okay, given that I know it's above here and below there, what's the difference going to be on average between these two? And that's what they do on pages 238 and 239 in the book. some people who tried to use the manual way like that skipped straight to the interpolation part, and so they got close but not quite right. Got them close. You got something like 2.66 or 2.69 if memory serves. If you did the interpolation method. The interpolation method is basically supposed to be going to try and go above or below it, and then be given two different answers, hone in about one answer above, one answer below, use the interpolation method to get closer. When you jump straight to it, it gets you close, but not as close as you need to be. So some people got this off slightly because they tried to do it manually, and the calculations and the exponents, a couple of you, I know what you're trying to do, but you just did typos and it threw your answer off. Not hugely off sometimes, but it threw it off because of typos. When you do, when you're trying to do something like this, which is the effective annual rate of return, you stick 1 plus your rate of return, the power of how many periods compounded, which is 2, and this is straight out of chapter 4 and the periods down in this chapter. Then minus 1. Okay, it gets you there using this. Some people messed up because they put times here instead of exponents. That's why, bless you for trying to do this in Excel and these manual calculations, but it's right for calculation errors because you just put your parentheses one place or forget your hat or your caret, I should say, as you used to do. Now then, here's the way the book did it on chapter 4 and 5. They take this rate, compound it for this many periods, and say, let's do it for 1 year to find out the effective rate, because this is the effective rate, annual rate per year for compounding. And we went over this in class on one of the examples. They put $1 in here and calculated this effective rate for 2 periods, meaning 2 periods a year, $1. The whole purpose of putting $1 is that so the future value ends up being 1.055. You take 1 minus that, and that gives you the 5.1%. So that 1.55 is 1.0551. So you take away 1 from that, and essentially you get the effective interest rate in a percent wise. So they do it by finding this effective rate. Both get to the same place by using this 1 plus D8, which is the rate you calculated, to the power of 2, because it's compounded twice, minus 1, and that's the minus 1 here shows the same function as here, taking minus 1 off this, and you convert it to a percent. This effective annual rate wasn't specifically asked for, but you could interpolate it was asked for. You say the effective rate. It says what rate of return, doesn't use the word effective. So if you did this as your final answer, that's why I'm going back and re-rating it. Some people highlighted this effective annual rate as a final answer. This is the rate that the question was asking for, but this is not a wrong answer per se, if you know what I mean. So I may mark people off for saying this is my final answer. Well, strictly this was the answer the book was looking for. But if you did this, it's not wrong. And you could interpret that. So tomorrow I would say, when I go through my second round, I'm going to look at these ones again. So if you see comments I made there this morning, give me till tomorrow when I redo my second round. As I said before, I always go through all the homeworks and assignments twice for this very reason, because if I see a bunch of people interpreting it one way, if the question says, let's build a dog, and everyone in the class builds a house, then I revisit the question. But that's essentially where, if you did this calculation, you might be off if you did this part off, but as long as I can see your calculations, you might get credit for the second part. But if you only did this part, the 2.72, you're not wrong. You could have stopped there. But if you did this, I have to go back and make sure, is your calculation off here because you were off here, or whatever, or because you have a calculation error. A lot of words in this problem, but it was one of those ones where different people took a different interpretation of it, and some did more than was required, but The more that required didn't mean you got the problem wrong. I have to go back and say, okay, you may have said, highlighted this part in green for your final answer, but really you already had that. You does show that you had this other part in there as well. Long-winded expression on how I'm going to grade this one, but I am going through it again. So no grade. If I posted someone's grade out there, it shouldn't have been out there. I may have comments posted, but I am going through this one again. If you don't like what I did, next week you can bring it up during Q&A or during a Zoom conference if we have one. Any questions on this one? Was I just, everyone's stunned for that. Alrighty, then I'm gonna close this. I'll save, because I can't remember what I changed, so I'll save it. Alrighty, so we'll jump into our exciting PowerPoints. It's 3:37, we could get out of here on time. Choosing the best alternative. Now the way they cite this chapter, it's almost like we haven't been doing that already, but we have. So generally when they talk about this, they're talking about mutually exclusive alternatives. And in this case, a lot of what we're doing is similar to what we did last week, and we're saying, okay, given that we can do two things, usually one has a different cost value. The book likes to make one of them twice as much as the other. Essentially, we're saying, okay, we have these two alternatives. We can calculate individual rates of return on it, but is it worth spending the extra money on the more expensive one? And that's when we have to do some of these incremental analysis to say, okay, if you got one that's $1,000 and does X percent, another one it costs $2,000 but does X percent, is it worth spending the extra money on one, even if it might be less return on the other, because you're only spending half the amount you could? Is it worth spending the whole amount? And that's one of the ways where this gets a little complicated. And the book likes to talk about choice tables where they say, here are options, this type of return for this type of scenario, you do this with that. They like it in a nice little table. So in most of the world, when I've been in this, the boss usually just doesn't want to be given a choice table. He says, what's your recommendation? But choice tables are great in textbooks. I've never been asked for one. I've created some, but I've never been asked for one in the real world. So here's a wonderful graph, 8.1. Oh my goodness. They're trying to convince you how wonderful graphs are in this chapter. And so graphs are a wonderful way of expressing certain things. A graph like this, I've presented some things like this, and one of my favorite expressions I've been using for years, and it didn't create for me, but one of my bosses said, who threw up on the page? And so I've always simplified my drawings ever since. So what they're trying to do here is say, give you a graphical solution, and the whole point of these graphical solutions is so you can see where these different options with different costs, different rates, different benefits, but in this case, similar lifetimes, where they overlap on their essentially present worth or net present value calculations at different rates of interest. Because what chapter 8 says, okay, we have this nice different way we're going to do a snack cart. And they have something use exclusive. We can serve 100 customers per hour at this cost, or $150 customers at this cost. Now then, different costs, different capacity levels. High cost, higher capacity. Now what we're saying is, okay, let's say we have $150. We're trying to say, at what point is it worth spending the whole $150 versus just 100 and live with this low capacity stuff? What do we need to have in place? And what they're trying to do is come up and say, well, at certain rates of interest, because assume you're going to, maybe have a line of credit that's $150, and then you're charged by the bank the payment called interest for that line of credit. They're trying to say at different interest rates, and they graph them along the bottom here, we generate a different set of present worth or net present value. So you have your interest rate, and this is essentially creating a net present value table. And what they're doing is saying, okay, you've got low capacity as a solid line, and here's your rate of return. And they plot for every interest rate, they calculate a net present value. I'll show you my tables on this in a minute. And so solid line is less than the big dotted line, meaning low capacity has a lower present worth up until you get to this 4.3%. How do they know that? They just looked at the graph and said, oh, that's about 4.3. Then they put it in and said, oh yes, they equal each other at this rate of return. Then at that rate, all of a sudden things switch, and it interest rates from 4.3 down to here, the low capacity gives you a better rate of return compared to the dotted line, which is the high capacity. And the whole point of this is saying, well, if money costs you between here and here, choose the high capacity version. On the other hand, if money costs you between here and here, use the low capacity version, because it generates a higher net present value at these interest rates. For the low capacity, generates higher net present value between 4.3 and like the 15 over here compared to the other capacity. They're basically trying to say you, depending on how much money, what money costs, you do one or the other. This is where interest rates come into play on making business decisions. Now then, they also say, here's the 5-button version. They basically say, let's stick in 5 years, $3,300, over $3,300, 5 years, initial cost. Minus 10, $3,300, future value 0, solve for I. That gives you that rate of return for that one. This gives you rate of return for that one. Now then, by subtracting the two, more expensive versus the less expensive, basically trying to say, is it worth spending the extra money on that more expensive one? Incrementally, it costs you, you get a 4.3% return by incrementally going to the higher cost version. So that's when they're trying to say, okay, where do they equal each other? They equal each other at the incremental rate right here. When you subtract the two, this version here is essentially saying, here's what this point is right here, by subtracting the two costs against each other. It actually would give you the same amount if you subtract the other way around, but you would have a negative sign. They always like to have the big high cost minus low cost so that your signs are in the right direction. It looks good. Now then, any questions before I go on to what I think my version of this is to help you decide things? What I did is something like this, and I can pull up my actual calculations on the spreadsheet here. I have a calculation spreadsheet, which I'm happy to share this. Let's look. Open, winter, that one. Oh, we're week 8. Lecture examples. I'll keep this off to one side so everyone can see exactly what I did. Slow Excel tonight. So what I did, I'll put the spreadsheet back up there in a second. And this is where it gets a little tricky. Here's this table down here is the cash flow. This end, low, high, and the delta between them. Outflow of cash to the beginning, inflow of cash, 18% internal rate of return, 15% rate of return, 4.3 if you take the incremental difference between the two. Now, essentially, then you can put this nice graph here. This nice graph, which is the same as their graph, you may not believe me, but I'll go backwards, making you guys go blind back and forth. Their little lines overlapping, intersecting at this point is my little lines intersecting at that point. Now, all I did to generate this is I said, here's the net present value of each one at 0%. So I took these cash flows, net present value of this, plus period 0. At 0% interest, I get a net present value of 6190. For the low cost, 66 for the high cost. And I plot it on the graph. That's these two. Then I said at 5%, what's the net present value of these cash flows at 5%? 39.77, 39.18. 5%, that's down here. Net present value is going along the vertical column, interest rates along here. All the way out to at 20%, they both start to lose money. So they're less than 0. Why did I choose 0, 5, 10, 15, 20? Because the book did. If you want to do the exact same thing for 0% through 20%, good for you. I did what the book did. So essentially what they're trying to say is, all they did is graph the net present values at each interest rate on this chart to find out these intersecting ways. And basically this is to tell you that up until here, it's more profitable to do one than the other. The high value, the gray one here, is more profitable between 0 and here, which happens to be 4.3%. Then, after interest rates get higher than that, you want to switch to the low initial cost one, because that one has a higher net present value for all these interest rates over here compared to this point where they're equal. And so that's kind of where they're trying to get you to say, okay, the incremental gives you the crossover point. I'm not really happy with this in general because under certain complicated scenarios where the calculations aren't as clean as this, lines can intersect each other multiple times. That happens in the real world. And if you take my economics class, you'll talk about how supply and demand curves sometimes intersect twice. But essentially what they're saying is up to a certain point, one is more favorable, a certain point of interest calculation, one generates more money than the other, and then it reverses after 4.3%. And find that reversing time is the whole point of taking the high cost minus low cost to give you that crossover point. Crossover point doesn't tell you which is higher or lower. It just tells you at this point, when you subtract the two cash flows from each other, that generates a point at which they are both equal, and it's a crossover. Now here's where I pause to give everyone to take a deep breath, because that's a lot of stuff I went through. And you got to take a deep breath and make sure philosophically you know what we're doing, because the calculations can be fairly simple, but philosophically we need to get our mind right on this. Does this make sense to anybody? 2 people. Cool. All right, so I can go on this one all night. But the reason this is so important in business is because if you know what your returns are at certain rates, this is when you go to the bank or creditors or stock investors and say, here's what rate of return we need to get, or here's what rate on our money we need to get if we're borrowing it to make it worthwhile doing this. In this case, you would say, well, after a certain point, it's not worth spending the extra money to invest, that extra $3,000 almost, or $2,007, $2,000 or so, $3,000 on the high cost version, even though it has more capacity, because if money costs you more than 4.3%, it's not worth putting the money into that higher expense. You're not getting as much return for the higher volume one. And that's where the cost of money starts becoming really important in this. But all they're doing on these graphs is graphing interest rates and on one long one and saying at that interest rate, what is the net present value of each project in order to decide which one to do. That's the philosophy behind this. Let's fill this up here quickly and just say the net present value on this is a little, let's zoom into here. I'll show you my table and all I did a graph. And the one thing I don't, let's see, okay, let me just go in the center. Here's how I created the data for my graph. All I did was say net present value for each one These are my cash flows, low and high. So I said, give me the net present value of these cash flows at 0%. I use the net present value function with 0% interest, K7 through K11, $3,300 a year. Could I have used an annuity calculation? Yes. Why bother? Net present value does it equally. Plus the initial outflow of 10,300, whoops. And that generates 6190. Exact same thing here, 5%. Net present value of the same cash flows, only 5% instead of 0%. Same minus 10,310 at year one, same $3,300 to give me this. As we expect, as the interest rate goes up, the net present value goes down because we're charging a higher cost of money. Higher the cost, lower the net present value, all things being equal. And in this case, all things are equal in this scenario because it's the same cash flows, different interest rates. So this is also a great way of saying, hey, internal rate of return is 18%, but doesn't mean you want to have that, but net present value varies dramatically depending on your interest rate. Who is this resonating with? I know 2 people said yes.
I got it.
3 people. But if I'm flogging a dead horse here, and please tell me I'm doing it if I need to go, but it's the philosophy. You got to figure out what they're doing. They're trying to determine interest rate ranges that it makes it viable or not viable to do one or the other. And that's what they talk about when they talk about tables, and they put it in a nice little table on page 282, and that's their version of a choice table, where they said from 0 to 4.3 high capacity, 4.3 to 18 low capacity, and then after 18%, we know nothing makes money, so don't do anything. And that's why they, in their last version, they basically say, hey, after 18%, neither one is viable because, well, this one loses money after 15%. This one loses money after 18%. So that's how they get their last choice, is basically saying after 18%, neither one is worthwhile. So we just put our money in the bank instead. And that's the whole thing where they go from here. Their version, nice diagrams, and my version get the same way. They just don't show you these calculations here, which is how they got the graphing to go. Pressing on. Now then, 8.4. Now the way they do it is going on to page 286. They got our equivalent annual cost stuff again. Now then, basically they got a life, three alternatives, a life for each one, and basically trying to say, okay, same type of thing again. At what rate of interest and what payment do we have to get to make one versus another? Now this is a cost factor. They're trying to say, okay, this is very similar to the last question. So we're doing with costs. We're still going to talk about present values of stuff. But essentially what you're being asked is this question. And I got brass, stainless, titanium, initial costs, 4 years, 10 years, 25 years. Okay, so at 4 years, so you got the 3 types of calculations the book likes to put it in. What we need to know is the payment rate at different interest rates. So you can say, depending on the cost of money, this one is acceptable compared to this one, compared to that one. And so I did the exact same thing again. I said, given different interest rates, given the present value of this, what's the equivalent annual cost of $100,000 over a 4-year period at different interest rates? So all I did is stick in a bunch of different i's using this payment calculation for each one of these alternatives: brass, stainless, titanium, brass, stainless, titanium. So I basically took 0%, stuck it in here, and said, okay, at 0%, what's the equivalent annual cost of a 4-year thing that cost me $100,000 today. At 0%, when I stick 0% in the I under brass, the payment amount comes out to $25,000. When I stick 5% in this I at the brass part, payment comes out to 2820 or 28201. And I did that same for each one. I just stuck what the equivalent annual cost or the payment essentially would be for that time period. Because this is a cost question. And a purist would say I probably should have these negative, but we're looking for least cost. So when I stick that in, I can look when I do some 0, 5, 10, 15, 20. Why did I do those? Because the book did it every 5 years and put it on the graph. The book has their graph on the bottom of 286. It's really the same as my graph. Only my graph comes off of these. But again, what they did is do a one minus the other incrementally. So they could say, okay, we want to come up with a range. So they go through their complicated thing of saying, okay, you can graph it and then say, where does this cross? That's just a guesstimate. But they do their incremental subtracting one from the other again, just like we did in the previous example. So they'll go through the high cost and put like, what's titanium minus steel? Come up with a threshold between those two. And that's how they came up with these down at the bottom here that are shaded. So essentially what they're saying now is, and you can see this in this table, and they like to use goal seek. Ugh. Don't. That's my MIS 375 course if you want to learn about goal seeking. You don't need to use goal seek. If you just graph these equations, you can come pretty close and say, okay, here, this is down there. Those two cross here, brass and titanium. They cross over here. You'll say we're just a little less than 10%. But you can easily see here which line has the highest cost between this and this. Oh, okay. Well, the highest cost is on the highest value here. Then you look at these things and say, okay, well, the one you want is the lowest cost. And this is where this example goes from different from the last one. What we want is the lowest cost alternative. Well, okay, that's when you come, look, lowest cost one is titanium from here to this point, which is that 6.3%, where you just say, okay, if I take titanium minus stainless, the most expensive one minus the least expensive one, or next less expensive one, this minus this, running these tables gives me the 6.3%. And you notice in this my little table, they're very close at 6.3% stainless and titanium. Just my calculations are like 24,105 versus 24,19, so they're off by $14. For his lazy input 0.6301111, I might get them exact. But essentially they take the most expensive minus the second most expensive, and that incremental amount gives you 6.3% for its internal rate of return. So you know the overlapping point between those two, the two you subtracted. Now then, if you did titanium minus brass, would that give you another number? Yeah, because that would then tell you, okay, where do brass and titanium intersect? Well, titanium and brass, that will give you something over here. But they use the practice of, let's start with the most expensive things, and the next most expensive thing, and then the next most expensive thing to come up with those variations. It's a good starting point. So that's how they come up with these numbers, is they incrementally take the cost of each one. And again, each one of these is the payment, annual payments you get. And I will stick my calculations over here. So all I did on each one of these is say, let's zoom in on here. I should zoom this whole thing. So here's how I did it. Payment function. Brass, I did the payment function and said that 4 years, $100,000 and 0%, that gives you your annual payment of $25,000. Same thing brass again, exact same figures, 4 years, negative $100,000, 5% interest rate. The annual equivalent of that $100,000 over 4 years at 5% is $28,201. Same brass again, at 10% interest rate, 4 years, $100,000. The only thing we're changing in each one of these calculations is the interest rate. At 10%, it gives me 31,000. This is going up each time because the interest rate goes up. The higher the interest rate, the higher your payment equivalent. You use goal seek in the homework if you want to, but be afraid. Don't call me saying, I can't figure out how to do the goal seek. If you're familiar with goal seek in Excel, feel free to do it. But no, I'm not going to teach to it. I think you can get the same place by just doing simple, graphing a few things here. And in one sense, you don't even need to graph. I was able to come up with a rough decision-making period just by putting the annual cost amounts here for each one at different interest rates, then saying, okay, where's the smallest one? Well, between 0 and 5%, titanium is smaller costs. All right, then between 10 and 15%, okay, is it exactly 10? No, we know from the thing it's actually 6.3%, not 5. But somewhere between 5 and 10%, which one is the cheapest? Switches. And then it's stainless. And if you want to do it other than goal seek, if in the real world, well, in the real world, I'd probably use an iteration algorithm. But you can do the same thing by saying, okay, let's stick 6% in here. Stick another line in here and say, okay, 6%. Is 6%, this is still the most. This happens if I stick in 7%. And the reason I can do this is because I'm locked now at 7%. Oh my goodness, something happened. At 7%, the cheapest one is now 24. And this is the iterations they're going through, and GoalSeek will do this for you, certain level of automatic, but I don't teach to it.
So if we were to use GoalSeek, then for the answer, we would just write down 6.3%. Before 6.3%, we use this. After this, between 6.3% and 15.3%, we use
exactly, and that's essentially what they do. If you look at the 287 in the middle, they give it's analogous to what they did on the first example. They give, okay, between these interest rates, use titanium. Between these interest rates, use stainless steel. Between these interest rates, use brass.
Okay, all right.
Well, what I did here is say, okay, we know that somewhere between 6 and 7%, it became more profitable or less costly to use stainless instead of titanium. Do you know the exact from here? No, but somewhere between 6 and 7%. If you really want to get inward attentive, you can say, okay, let's make this 6.5, then copy these down. Then, oh my goodness, yep. Somewhere, this is somewhere it's whatever is going to change over at 6.5. It's still cheaper to use titanium. So somewhere, the magic answer is somewhere between 6.0 and 6.5. And again, you don't have to be this inward attentive about it. I'm looking for the mechanics. Let's say, what if we did 6.25? I can do this quickly just because I did all my formulas referencing properly. Oh, somewhere. So what we know here is that between 6, and this is actually 6.25, but somewhere between 6.25 and 6.5, it becomes less costly to use stainless than titanium. 24.28 versus 24.59. But here something switches, and 24.590 is less than that. So somewhere between 6.25 and 6.5, the profitability changes. And so if you want to goal seek and learn how to use that function, feel free. I'm not going to teach the goal seek in this class because some people have different levels of Excel, and that's using those goal seeking. That's when you have to get some of the statistical packages and that. And I'm not going to teach that here. I wish they taught it in the Excel class. But you learn to use that in the MIS 375 if you dare take it. It's almost as hard as this one. No, it's a little harder than this one. So anyway, but that's the whole thing they're doing. And all it comes down to, so they can put this nice graph in. This graph is essentially their graph and is a little bit more curvy than their graph is because I put more lines in it. So whereas their one goes in nice straight lines, mine's the same graph as theirs on the bottom of page 286. It's just that I go from, instead of going 5, 10, 15, 20, this now goes from 5, 0, 5, 6, 6 1/4, 6, 5, 6.7, then 10, 15, 20. That's the only reason it's not a straight line, is because I added these extra ones. But the whole idea here again is saying, at what level is lowest cost? Well, titanium, which is this nice silver color, is lowest cost until you get to here, which you know is about 6 1/4, or if we did the subtractions, the incremental between the two, we know it's 6.3. Then it switches after a certain point, and after 20%, it comes down to this nice little brass becomes profitable. And that's where you see that same little choice table they do. If you do, you know, they specifically ask these questions for a choice table. He gave you something analogous to this that shows you know how to math and know what you're doing. That's just as, I'd set that just as good. If you want to put it in a nice little table like they have on, 287, that's fine too. But when you put something like this, I can see the calculations and how you got it. But it's the exact same thing. Before we're dealing with net present value, this time we're dealing with the annualized costs. You're given present value, the time period to annualize it over, then you just got to plug in interest rates. Any questions on that one? I'm hoping that everyone's just clicking the gas now. All right, now, here's where, this is the last example I use tonight. And it's 8.7. Income analysis using pairwise comparisons. Now then, this is basically, I exceeded my margins. Basically got a whole bunch of these things, and what they're trying to do in here is first thing they tell you to do, they give these initial costs and annual benefits. Cool. Well, uniform annual benefits, that'll tell you some things. We're dealing with some form of, annual annuity type of thing. Uniform annual benefit, initial costs. So they want to know no salvage value, 20 years. You got your 20-year life. So you know your cash flows, at least your code annual cash flows. And what they try to do is basically say, okay, they like to put them in order of least expensive to most expensive. And they do the same calculations you're doing incrementally a couple at a time and say, where does it leave me off? Now then, this is what they did. And they go through, I'm not going to go through that wonderful myriad of stuff that's on, it goes on 292. But it's the same type of calculations. They're basically looking for the rates at which it makes sense to do one thing versus the other. Now then, here's what I did. First off, I took this and basically took the cash flows and said, in the periods, and said, okay, essentially what's the rate? What's the rate of return, internal rate of return on each of these? This is a starting point. Okay, because a lot of these incremental stuff come at, and if you're just using rates of return, this essentially tells you right away which has the highest rate of return. Right away. I stick them into our usual I. Everyone sees 20. How do we know this payment is 639? Because they give it to us right there on A. Initial cost of 4,000, negative 4,000 payment over 20 years. It's got a rate of return of 15%. Now, essentially, this they have a reason for going through this bypassing, incremental analysis. Of an example is to teach you the technique. So I kind of short circuit it on my way of doing it and saying, okay, let's just start off by saying, what's the internal rate of return on each one? Cool. Now that doesn't give you necessarily ranges of what's the right one to choose over different interest rates, but it's not exactly, it's a different type of question, if you will. Just says, which one should we do with an interest rate of 10%? Cool, well, this is the internal rate of return. If the interest rate, the best, it says, which alternative is best at interest rate of 10%? In one sense, if you got 10%, you already know you can throw away two of them. 9.9 and 6 are less than 10%. On percentage weights, which one is more than 10%? 20 is a lot more than 10%. But that's only part of the answer. So what I did is, and this is where it's a great example of what makes sense to do, and I include this one, even though it seems a lot when you go through steps 1 through 6, it seems like a lot that they're doing, but it's very systematic. If you look what they're doing, it's very systematic. They're doing the same thing over and over. They're using rates in the back of the book instead of Excel. Okay, but here's what I did. I put it as a cash flow, equivalent annual benefit for each one, and I got the same internal rates of return for each one up there. But I also put in net present value because I want to be able to show you that, once again, in a vacuum, internal rate of return is flawed. Now you can make a decision on the basis of this and say, okay, which is the best alternative? And they give, they say B is to E in that. Okay. They go through all these iterations to basically come up at the end and say 19.96% is bigger than 6.01% by doing one versus the other, more expensive, least expensive. You kind of get the same place using internal rate of return, but the rub here, and this the conversation point we have for this is, hey, net present value. If the internal rate of return is your choice, which one would you select by internal rate of return? Someone take a risk. If internal rate of return is your criteria, which one of these is best alternative? A, B, C, D, or E? B.
B.
Fantastic. How do we know that? Because it's bigger. Now then, if you're using net present value, which one do we select?
E.
What the heck do you do? And this is the dilemma. And during the article, a couple of people put on some nice anti-internal rate of during your article assignment. A couple of people put some nice anti-internal rate of return articles on, which just speak to my heart. But this sort of gives an example. They didn't call in the example to do net present value. They try to do it through, which one had the best return, and do it incrementally, one versus the other, one versus the other. Or you can just stick them all by yourself and say, hey, what's the return on each one? But what's your criteria for making decisions? By interest rate is this one. But the lowest rate of return yields the highest cash flow. And this is, you say, so which one would I choose? Well, I'm more fond of net present value than internal rate of return, but it comes down to the point where this is a great example because the lowest rate of return is the highest cash flow. What are your circumstances? What do you need to be concerned with in your organization? It's easy to say, oh, look, we got this massive rate of return, but boy, I could have gotten 6% more if I'd gone with this route, the lower rate of return. And we wouldn't have to borrow money from the bank to meet payroll. So this is the dilemma of the two most prominent, net present value and internal rate of return. Actually, payback's probably more prevalent than internal rate of return, but we'll deal with payback period later. but just treat this as an example. Read through how they do it on that chat. Well, you've already read it because it's required to read the chapter for this. But so I would read it again as you go through this. You get a question like this, but treat this example when you put net present value. And I always see you doing this over and over on homework problems, even when it's not required, just to get you used to the fact that either one of these by themselves don't tell the whole story. You've got to use multiple criteria when making these type of economic decisions. Anyone by itself is fraught with issues. And if you can come up with how to make a decision on this one, I couldn't make a decision amongst these without more information from management about why we're making decisions. And if you're the guy in the basement, like Bill Gates was, doing old stuff with a couple of college buddies, you got to come up with your criteria about what's most important for you in making decisions amongst these options. So any questions on that? On how I did it? Did it a different way than the book did? Both are valid. Mine's faster. But I take shortcuts. You good with this? Okay, now then, a couple of quick things from that the book talks about. Minimal accepted rate of return. And this is where this type of stuff may come into play. If your organization, like this example said, 10% or more, it's a short-sighted way of doing business, but it's out there. 10% or more, you exclude you exclude the lowest net present value and the highest net present value based on the criteria of this problem. So they say 10% or more. 9.4 is less than 10%, but it also has the lowest net present value. 6.01 is less than 10%, but it has the highest net present value. But they set line in the sand at 10%. It's problematic, but it's so obnoxiously common. All right, if it's not known or known approximately, use a graph. And that's why the first part of this chapter uses those graphs to say what rate should we be concerned about. Because saying, hey, we don't know what we can get for the bank. We don't know what our internal return. We don't have a big accounting function that can generate this based on a weighted average cost of capital. Don't worry about what that is yet. So given what we know about there, we know what our savings account pays, this pays. At what rates does it make sense to do something versus nothing? And you have multiple alternatives to choose from and say at this range of interest rates, this makes sense. At this range of interest rates, this option makes sense. But depending on the interest rate, how it changes, different options fall in and out of viability. And that's the big thing to get about those first two examples, the first half of this chapter. Graphical approach is great. But as I said, I just sometimes I can get the same thing from putting a table in there and say, look, from this range, and just highlight the ones that are either lowest if it's a cost issue or highest if it's a profitability issue. The rate of return analysis, and this is the point where I've said it before, it's easy to explain, so it's used so often because you can say, look, everyone knows interest rates. Everyone's got an interest rate. They got an interest rate on their car, their house, their bank account, their checking account, which is like 0.0000001%. But it's easy, so it's used overused. And most firms have a way of using it and measuring it. Use it. One of the biggest things that, especially when you work for a larger company, I remember coming to this at Metro Graphics, and when they were talking about what rates to use and what methodologies I'd like to use. And I actually just sent an email to the controller one day of the company, who was essentially the oversight of accounting processes. Said, do you guys have a preferred method of analysis that you like to see in different analysis types of things? Yeah, we prefer to use so-and-so and we use rate of return most often. Here's our acceptable methodology. Okay, if I know they like to see certain things a certain way, you can argue ethically, but okay, if no one cares about net present value and no one knows what it means, should I go there and risk upsetting people? I usually do anyway, because the first thing I do is give all sorts of different returns. But the other thing is if you're using a method that your organization recommends and someone else isn't, and it's between your project and theirs, and if you can show that you use the criteria that is set up by the company as a preferred method, you're in like Flynn, and you can shoot down someone else's project. All righty, let's take a quick break Everyone want 10 minutes before we go in breakout sessions? Anyone need more than 10 minutes? 2, 3, 4 people say 10 minutes. All right. I'll see you back here at what, 4:32.